Hi, I'm James Robinson, and this is my stock pick of the week. This week's stock is a company called VALU Line, symbol VALU. Kind of an interesting story about this stock. I actually bought this stock probably about 3 years ago. When I first started trying to analyze companies, people say, hey, how do you find these small companies like VALU Line, which you're going to see is a very small company? They're not really on anybody's radar. So what I did is I took I made a list of the S&P 500, which is the largest companies, the S&P 500 or 600 mid cap and the S&P 400 small cap and the Russell 2000. And I made a list of all of those companies. And then I ruled out insurance companies and banks, a couple of other industries that I didn't really like. And I came up with about 1,500 companies that I wanted to analyze. And then what I did is I just started with Z. I figured if I start with A, well, lots of people do that and then run out of steam. So I started with Z and I've been working my way back towards A. And so VALU Line, because it's a V, is one of the earlier companies that I looked at. And it was really my first superstar company that I just love the financials. I love the outlook on this company. So we're going to go through this in the next 5 videos. As you know, I look at a company and I look at it from 5 different perspectives. This is the overview. We'll just give you the broad brushes of the company, why I'm initially interested in it. And then I dive down deeper and I look at its operations, we look at its balance sheet, we look at the company's dividends and the wealth creating characteristics. So this is a video on VALU Line. So before I go any further, if you'd like real-time information on when I buy or sell a company, I'd like to suggest that you follow me on Twitter. My handle is @RobinsonStocks. I don't always make videos, and I certainly don't make videos right away when I buy a stock, especially if I've already made a video in the past about a company. And oftentimes I do rebuy companies that I have owned in the past because I like them and they become affordable again. So real-time information on trades, you'll find that on Twitter, buying and selling. You'll also find information when I'm posting new videos. And I put news and thoughts on the market, other things that I find interesting on Twitter occasionally. So also, if you would subscribe to this page, I'd love that. And like as well as comment. Thanks. So this data is as of August 9th, 2020. VALU Line is a small company. It's a market cap of $259 million. So it's a small enough company that's below everybody's radar. Interestingly enough, the company is also very, very thinly traded. Not a lot of shares trade hands every day. So when you buy your stock positions, I would suggest that you do it as a limit order, because if you make a $20 or $30 or $50,000 purchase, for example, you're likely to move the value of the stock all by itself. And that, by the way, is something that's really cool about this company. If you look at what the stock price is before you place your order, then you place your order, oftentimes you'll see that the value of the company will have moved, and it's kind of neat to have that kind of power. But anyways, when you buy the company, buy it carefully, put a market cap on so that you don't buy it above whatever price you think makes sense. The company has revenues of $41 million, and it has profits of $17 million. And if you think about that, that's fantastic. That means, again, just over half of all dollars that come into the company are profit. Also, the company has about 170 employees, 165 employees, and they make $17 million in profit. So that's about $100,000 of profit for every employee working at the place. That's a very efficiently, very well-run company. The company's PE ratio is currently 14.97, so call it 15%. The company pays a very nice yield of 3.11%. The company historically, for most of its history, has had virtually no debt or no debt. Right now, they have $11 million worth of debt, but when you have a $259 million market cap, the debt isn't significant. And when you have, less than a year's worth of income in debt, again, it's not a significant number. Interest payments aren't going to be a problem with this company. So the debt isn't an issue when you look at VALU Line. So what does VALU Line do? VALU Line and its subsidiaries produce and sell investment periodicals and related publications in the United States. So their periodicals and related publications are related to investments in stocks, mutual funds, ETFs, and options. They offer researches as well. They've got the VALU Line Investment Survey, VALU Line Small and Mid Cap Surveys, the VALU Line 600, the VALU Line Fund Analysis, et cetera, et cetera. An interesting side note, VALU Line tried to hire Warren Buffett when he was coming out of Columbia for his MBA. So these guys are really good at finding researchers, as you can imagine. Imagine how much different the world would be if he'd gone to work for VALU Line instead of going to work for the Graham Investment Fund. They also provide niche newsletters. They also have a website, and on the website you can do various forms of research and analysis on stocks. The company serves individuals as well as professionals. They also serve institutions. They give information for municipals, libraries, universities, as well as investment firms. Value Line was founded way back in 1931, so it's just under 100 years old. It's headquartered in New York, and as I said earlier, it has 165 employees. So those employees are very, very efficient in terms of the output and profits they create. So in terms of the scores for this company, just to recap, I grade companies on 29 categories, all of which are relatively important, some more important than others. I just did a video, for example, on gross margins and why I think that's so important and why that's the first thing I look at in a company. But all these things are important to some degree, and I rate how the company does on a scale of 1 to 4, just like when you're in college, with a 4 being the best. So in theory, a 4.0 would be straight A's, although I've never had a company come close to that. I look at the categories. The 29 companies are 9 operating categories, 10 financial categories. Finance is how the company handles risk, what they do with their money. And then management, I'm at 10 management categories, and management is how good a job the company does in creating wealth for the shareholders and or returning profit to the shareholders. So all told, this company has a 3.78 GPA. I'm sorry, as a total GPA of 3.48, which is fantastic. 3.78% in operating, 3.5 in management, 3.2 in financial. So the financial categories, why would I give a company a bad rating when they have virtually no debt, right? It's because I look at these things individually, and I put the whole package together and analyze it as a whole once I've done that. But I do look at things individually. The current ratio, the company doesn't keep a lot of cash on hand. And in theory, now that's because I think they're a very standardized subscription service model, and they know they're going to get checks every month and use those checks to pay people. But the truth is the current ratio isn't that great. They don't have a lot of cash in the bank. It doesn't bother me that they don't have cash in the bank because I don't think they need it. And that means they're just returning more to me, the shareholder. But it also means if something were to go wrong, they don't have a lot of reserves. Now, they also have no debt, and so they can borrow money. And that's why I'm saying, if you look at these things individually, they don't tell you the whole story. It would tell you this company's got a current ratio. That's a cause for concern. But when you put it in the context of they have no debt and a subscription model and yada, 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 you come to realize that that's not really that important. But individually, that's the score I give it. 10-year return on retained earnings is actually not very good for this company. That's not a big problem also because they don't retain a lot of earnings. If this company was an auto manufacturer and they were keeping a whole bunch of my money and then not using it very wisely to create profits, I'd be very concerned. These guys are keeping a very, very tiny bit of money, and then they're just reinvesting in the business in probably areas where they can't recoup much of a profit. It doesn't bother me because the company is very, very profitable and they're not taking very much money out for retained earnings. So that's sort of the overview on Value Line. We're going to do future videos on their operations, on their balance sheet, on their dividends, and on the company's ability to create wealth for the shareholders. So hopefully you'll tune in. Thank you very much.